Good afternoon, coming to you live from Nasdaq's global headquarters in Lower Manhattan. Welcome to the Tuesday edition of Advisory Live, brought to you by Corporate Solutions. I'm your host, Will Briganti, and I'm joined by Masoud Ghoussi. Masoud, thanks for being here.
How's it going, Will?
It's going well. Great to have you back. So we're going to be talking about the debt environment. So with rate hikes, the ECB potentially ending quantitative easing, perhaps this is a good time to view how debt levels are right now in corporate America. What can you tell us?
Yeah, so there's signs of froth everywhere, or in Alan Greenspan's word, irrational exuberance. Irrational exuberance meaning enthusiasm not supported by fundamentals. If we look at the U.S. high-grade credit market, issuance has been $1 trillion so far this year. This is set to surpass last year's record, 2016. $1.35 trillion of debt was issued by high-grade corporates. So we're looking to surpass that. And the reason being, with interest rates looking to go up, issuers are rushing to market to lock in low and favorable rates. So they're looking to issue as much debt as possible. So that's one.
Yep.
Two, in terms of market value of investment-grade bonds, from $2 trillion up to $5 trillion over the course of 9 years, so from 2009 all the way to 2017.
Yeah.
So debt essentially in corporate America has doubled.
Right.
If we look at leverage ratios, so total debt over EBITDA, we're looking at about 2.9 times. This is significantly higher than the pre-financial crisis lows of 2007 of 2 times.
Yeah.
So companies are levering up more.
Right.
In terms of the junk bond market, we're looking at yields of about 5.8%. In 2015, we saw yields at 10%. Current 5.8% is about 4% over and above treasuries. Again, at record lows. Last time we saw this was during the pre-financial crisis.
Okay.
Finally, some interesting tidbits. If we look at Tesla, these guys do not generate cash. They're cash flow negative. However, they were able to lock in a loan recently. They issued a debt at 5.8%. They expanded their bond from 1.5 billion to 1.8 billion due to increased demand from investors. And if you look at bonds that are 8 years in maturity and trading at around B minus, this is a record low. And only a few months ago, this was pretty much unconceivable, these kind of rates.
Sure.
And the M&A environment for debt is also very favorable.
Right. Now, Masoud, that's terrific insight. Wouldn't interest rates also affect share buybacks? Any comments there?
Yeah, great point. So over the last 8-9 years, we saw a lot of companies lever up. We just talked about how debt levels have gone up. Reason being, cost of debt was very low. We had accommodative monetary policy coming from central banks. And then the idea from a central bank perspective is to keep interest rates low in order to invigorate economic growth. As companies expand their balance sheet, they probably look to expand their businesses, use the loans to expand their businesses. But however, that does not necessarily play out that way. And we saw corporates, again, borrow a lot of money, and essentially start buying back shares. So when they would expand EPS, earnings per share, it would be through the denominator effect, as in buying back shares. However, with interest rates going up and the talk, as you mentioned, of the ECB probably ending their QE program, issuers are probably realizing that interest rate levels are going to go up. And as such, we're seeing share buybacks come down a little bit this year. And there was a SocGen report that came out saying this year it's down 20% so far.
And Masoud, my last question for you is, we had the consumer price index from last Friday. We've also been discussing the Federal Reserve a lot this month. What's next?
So CPI levels, which came out on Friday, was a little bit of a disappointment. They were not as robust as investors / the Fed had hoped for.
Right.
So the Fed has a dual mandate. One is to keep employment high, and one is to control the price levels. So on the unemployment side, they seem to be doing well. They, as in the market, seem to be doing well. And unemployment figures have come down. With respect to CPI, they're not there yet. So this has thrown a little bit of uncertainty when it comes to rate hikes. However, I think it was yesterday or maybe Friday, Federal Reserve's Dudley spoke, and he said there is a rate hike still down the horizon in December. If you look at the markets, they're pricing in a 50% chance of a rate hike. and Treasury yields have climbed over the last few days.
All right, Masood, we'll leave it there. Thank you so much for that terrific insight today.
Thanks, Will.
I appreciate you being here. Ladies and gentlemen, thanks so much for viewing the Tuesday edition of Nasdaq Advisory Live, brought to you by Corporate Solutions. Be sure to come back and tune in for the Thursday edition. We're going to be talking about the 13F filings that are starting to come out this week. So we appreciate you watching. For more information about Nasdaq Corporate Solutions, be sure to visit our website. That's business.nasdaq.com. You can always follow us right here on Twitter at MyCorpSolutions. Thanks so much for joining. Have a great day.